The collapse didn't arrive like a storm. Storms at least give warnings. This one seeped in quietly, like a toxin entering the bloodstream of an economy that believed itself immortal. It began with lights flickering off in office towers that once pulsed with human movement. Entire floors went dark, not because of disaster, but because no one needed to return. Cities that once bragged about growth suddenly carried an eerie stillness, the silence of a machine that had already stopped functioning. The real estate crash isn't approaching, it has already begun. And the most unsettling truth is that almost no one noticed the exact moment the ground gave way. It started with isolated tremors, a billion-dollar commercial complex defaulting on its loan in the dead of night. Lenders quietly extending pretend and extend agreements to avoid marking down losses. A sudden spike in properties being returned to banks by owners who simply walked away. Each event looked unrelated, a coincidence in the fog of an uncertain economy. But every tremor pointed to something deeper, a foundational fracture beneath the weight of trillions in debt. For a decade, the world operated on a lie, that interest rates would remain near zero forever, that refinancing was infinite, that risk itself had been erased by clever financial engineering. Developers borrowed as if money were oxygen. Corporations signed office leases assuming uninterrupted growth. Families stretched their budgets with the confidence of people who believed the system would never let them fall. But systems break, and this one broke the moment the cost of money returned to reality. When interest rates surged to levels unseen in 40 years, the arithmetic underpinning the global real estate market collapsed. Overnight, loans that once cost 3% began renewing at 7%, 8%, even 10%. A trillion-dollar shift in debt service costs hit landlords like a tidal wave. Their cash flows evaporated, their valuations imploded, their lenders panicked. And then came the refinancing cliff, the great unspoken catastrophe. $3 trillion in real estate-backed loans are now aging into a rate environment in which repayment is not just difficult, but mathematically impossible. Buildings that once generated healthy profits now bleed money every month. Owners don't need to be convinced to give up. The market is pushing them towards surrender. Cities feel it first. Once crowded downtowns echo with emptiness. Towers designed for 20,000 workers now host a few hundred. Restaurants close. Transit systems lose riders. Tax revenues evaporate. A slow-moving implosion begins to ripple outward. Banks feel it next. They see the internal numbers, the write-downs, the silent defaults, the shrinking collateral values. They understand what the public does not, that a portion of the real estate market is already dead, it just hasn't been buried. And eventually, the people feel it. They feel it when their property values stagnate. They feel it when lenders tighten credit. They feel it when jobs tied to construction, development, and lending quietly disappear. They feel it when the narrative shifts from a temporary slowdown to a structural reset. Every crash begins with denial. This one is no different. Governments promise stability. Analysts insist the worst is over. Experts soothe the public with carefully chosen language designed to reduce panic. But beneath the surface, the truth grows harder to conceal. The fuse has already been lit. The timer is already counting down. And the first explosions, defaults, write-downs, vanishing equity, collapsing occupancy, have already ripped through the foundation. This is not a forecast, it is a post-mortem. The $3 trillion time bomb is no longer ticking in the future, it's ticking beneath our feet. History does not repeat, it stalks us. It waits patiently for the moment when we forget its lessons, when we start believing our era is immune to the forces that crushed the generations before us. Every real estate boom in history has carried the same DNA, the same quiet arrogance, the same belief in permanence. And every collapse has followed the same sequence, as predictable as gravity and just as unforgiving. To understand the danger we face now, we must revisit the ghosts of past crashes, not as distant events, but as mirrors reflecting our present. In 1873, the United States collapsed under the weight of a credit-fueled railway expansion. Investors believed the railroads would generate infinite returns. Banks financed tracks to nowhere. The public poured savings into speculative land. But when credit tightened, the system snapped. Banks failed. Projects halted mid-construction. Land prices imploded. The entire economy fell into what historians now call the Long Depression, a decade of stagnation triggered by a simple truth. Borrowing had outgrown reality. More than a century later, Japan lived through a collapse even more surreal. By 1990, the land beneath Tokyo's Imperial Palace was valued higher than the entire state of California. Office towers were traded like chips in a casino. Japanese banks lent with the confidence of institutions that believed land could never fall. But it did. When the bubble burst, prices plunged by 80%, and the Japanese economy entered a 30-year coma, a slow-motion disaster still felt today. And then came 2008, the catastrophe most people believe was a once-in-a-lifetime event. But the housing bubble wasn't unique. It was simply a modern expression of ancient behaviors. Cheap money, reckless lending, public delusion, a sudden reversal in credit conditions. Once again, borrowers found themselves trapped under loans they couldn't repay. Banks discovered their assets were fictitious, and the global financial system teetered on the edge of collapse. More than 6 million American families lost their homes. Different eras, different countries, different assets, but the same underlying pattern. 1. A belief that real estate is a safe investment. 2. A surge in borrowing fueled by low interest rates. 3. An explosion in prices driven not by fundamentals, but by leverage. 4. A turning point, usually a shift in interest rates. 5. A chain reaction of defaults, panic, and forced liquidation. This is the life cycle of a real estate bubble. It is simple, it is brutal, and it is universal. Yet every generation convinces itself that this time is different. We told ourselves that cities would always grow. We told ourselves that demand would always rise. We told ourselves that credit would always be cheap. We told ourselves that 2008 had taught us enough to prevent another crisis. But history is merciless to those who claim immunity. The pattern is not just repeating, it is intensifying. Because never before has the world built so much real estate on such an unstable foundation of debt. Never before have governments, corporations, and households been so synchronized in their exposure to rising interest rates. Never before has a global property market been this interconnected, this inflated, and this vulnerable. Patterns become predictions when they are ignored, and the pattern tells us something terrifying. We are not witnessing a slowdown. We are reliving the opening act of every major real estate collapse in history, with more leverage, more risk, and far higher stakes. The past is not behind us. It is beneath us, and it is beginning to crack. If history provides the pattern, then the present provides the chilling confirmation. What we are living through today is not an echo of past crashes. It is their evolution. A more complex, more leveraged, more global version of every real estate collapse that came before. The parallels aren't subtle anymore. They are glaring, unavoidable, and accelerating. The first and most devastating parallel is the violent shift in interest rates. In every historic crash, rising rates triggered the unraveling. But today's rate shock didn't simply trigger a downturn, it detonated the very assumptions the modern property market was built on. For more than a decade, the world lived inside an illusion. Money was nearly free, debt was harmless, and refinancing was infinite. Investors didn't buy buildings, they bought cash flows engineered by near-zero borrowing costs. Developers didn't build based on demand, they built based on cheap leverage. corporations didn't sign leases they could comfortably sustain. They signed leases they assumed would never need to survive a high-rate world. But illusions collapse the moment reality returns. And reality returned with a vengeance. Rates rose at the fastest pace in 4 decades, obliterating financial models overnight. What once looked profitable now bleeds money. What once looked stable now crumbles under its own weight. A building purchased 5 years ago with a 3% loan now faces refinancing at 8% or higher. The cash flow doesn't just shrink, it flips negative. The value doesn't just fall, it implodes. This brings us to the second parallel, the refinancing cliff. In 2008, it was subprime mortgages. In the 1990s Japan, it was corporate borrowing. Today, it is $3 trillion in real estate-backed debt maturing into a rate environment that no business model can survive. These loans must be refinanced at rates that turn once valuable properties into financial liabilities. Landlords can't pay. Banks won't renew without massive capital injections, and buyers refuse to touch assets that may be worth half as much next year. This is not a market correction. It is a systemic choke point. The third parallel is falling occupancy, especially in commercial real estate. When Japan's bubble burst, vacancy surged. When 2008 hit, homeowners abandoned their properties. Today, entire office districts sit half-empty because the workforce never returned. Remote work didn't just disrupt demand, it rewrote the economic equation of the office tower. A building with 60% occupancy isn't just underperforming. In many cases, it is financially dead. The rent collected cannot cover rising debt costs, maintenance, taxes, insurance, and utilities. And once the math fails, the building becomes unsalvageable. Cities feel the damage first. Tax revenues shrink, transit systems weaken. Restaurants, shops, and services evaporate. The ecosystem built around office workers collapses. The fourth parallel is the same force that magnified every previous crisis: leverage. Too much credit chasing too few fundamentals. Too much optimism built on too little cash flow. Too many promises made on the assumption that the future would resemble the past. Except the future broke its promise. And now the present is beginning to resemble something alarmingly familiar. But perhaps the darkest parallel, the one no analyst wants to admit, is psychological. The same denial, the same confident predictions of a soft landing, the same assurances that the worst is behind us. These words appeared before the panic of 1873, before Japan's collapse, before 2008. They appear now with the same hollow certainty. The truth is unavoidable. This is the same cycle, but with new accelerants. Higher rates, more debt, lower demand, institutional ownership, demographic decline, global synchronization. We are not repeating history, we are multiplying it, and the point where parallels become consequences is rapidly approaching. Because cycles do not ask for permission to repeat, they return when the conditions are right, and the conditions have never been more perfect for a mass unraveling of the global real estate market. The present is not merely similar to the past, it is the past, wearing a sharper blade. Every crisis creates victims, but every crisis also creates winners, not by luck, not by accident, but by design. When a system collapses, it does not collapse in a vacuum, it collapses in a direction. And that direction almost always points toward the same beneficiaries, the institutions that control liquidity, credit, and policy. The public is taught to see crashes as natural disasters, unpredictable, unfortunate, unavoidable. But behind the curtain, the mechanics are far more deliberate. Real estate markets don't implode solely because of economic forces. They implode because those forces are amplified, redirected, and weaponized by the actors who stand to profit from the fallout. To understand the revelation, we must follow the money, not where it went, but where it is going. When central banks unleashed the fastest interest rate hikes in 40 years, they knew the consequences. They understood the architecture of the global property market. They knew that trillions of dollars in real estate-backed loans were built on the assumption of cheap money. They knew that raising rates would not simply cool the market, it would crush it. They knew defaults would surge. They knew valuations would collapse. They knew entire sectors would be forced into distress. And yet, they proceeded with surgical precision. Why? Because rate shocks do something no boom can ever achieve. They transfer ownership. They take property away from those who borrowed and hand it at a steep discount to those who hold the cash. The elites didn't create the entire crisis, but they created the conditions that guarantee its outcome. Large financial institutions, private equity giants, and multi-billion-dollar real estate conglomerates have been quietly preparing for this moment. They have spent the last decade amassing dry powder, capital waiting to be deployed when the market finally buckles. They don't fear crashes. Crashes are shopping seasons. In 2008, they perfected the model. When millions lost their homes, these institutions purchased entire neighborhoods for pennies on the dollar. Those foreclosures didn't vanish. They became rental empires. Families who once owned homes became tenants of corporate landlords. Today, the innovation is more efficient. The consolidation is more sophisticated. The players are more powerful. As commercial landlords default, as office towers revert to lenders, as multifamily owners drown under rising debt costs, the same institutions circle like vultures, with balance sheets strong enough to swallow entire sections of cities. They don't need to outbid the public. The public cannot bid at all. Liquidity is the real weapon. Credit access is the gatekeeper. Policy is the shepherd guiding the flock toward a single destination. Even the narrative is strategically crafted. The public hears phrases like market correction, necessary stabilizing, and return to equilibrium. But the truth behind those terms is brutal, a forced reallocation of property from the many to the few. Pension funds, sovereign wealth funds, private equity giants, they are not waiting for the market to recover. They are waiting for it to break further. Every default strengthens their position. Every distressed sale widens their reach. Every failed refinancing brings more assets into their orbit. Real estate crashes don't erase ownership, they rearrange it. And the revelation is this: the crash is not merely a financial event. It is a mechanism, a transfer device, a consolidation engine. Once the dust settles, the landscape will look familiar but fundamentally altered. Fewer hands holding more property. More people renting from fewer owners. Markets shaped not by supply and demand, but by strategy and force. This is the part of the story the public is not meant to witness. The moment when the mask slips, and we see the architecture of control beneath the chaos. Crises do not humble the elite, they empower them. Because while everyone else is trying to survive the collapse, the architects are preparing to buy the rubble. And the rubble this time is worth trillions. The crash is no longer a question of if or even when. It is happening. It is unfolding in real time, piece by piece, city by city, balance sheet by balance sheet. But collapse is never the final chapter. It is the clearing of the stage before a new order emerges. And in that emergence lies both danger and possibility. For months, people have clung to the idea of a soft landing, hoping the market might somehow defy mathematical gravity. But gravity is undefeated. The system, built on cheap credit, was never meant to survive expensive money. We are watching a structure designed for one world struggle to exist in another. And like all fragile systems, it is breaking exactly where it was always weakest: debt, leverage, and blind optimism. But inevitability does not equal hopelessness. It simply means the old world cannot be saved. And that may be the most important truth of all. Because once the illusions collapse, the illusion that real estate always appreciates, the illusion that refinancing is infinite, the illusion that debt is harmless, something more honest begins to grow in their place. The future of real estate will not belong to the institutions that over-leverage themselves into oblivion, nor will it belong to the policymakers who engineered the crash and now pretend to control its path. It will belong to those who understand that resets are opportunities disguised as disasters. When the dust finally settles, markets will be forced to return to fundamentals. Properties valued by what they generate, not how much they can be borrowed against. Homes purchased because they are useful, not because they are speculative chips. Cities redesigned for resilience, not for an endless flow of office workers who never came back. Ownership structures expanded, democratized, rebuilt through transparency rather than leverage. For decades, the elites dominated real estate because debt allowed them to scale indefinitely. But collapses do something profound. They level the playing field. When over-leveraged giants fall, they fall hard. When inflated assets deflate, they become accessible again. When speculation dies, opportunity returns. The crash will not be clean. It will not be quick. It will not be painless. But it will break the spell that allowed a handful of institutions to accumulate vast landscapes of property while the public was pushed into lifelong renting. It will expose the vulnerabilities of a system that pretended to be indestructible. It will force a correction not just in prices, but in power. And after the fire, something new begins. Maybe it's a return to cash-based markets. Maybe it's decentralized ownership verified by digital registries. Maybe it's communities reclaiming forgotten buildings. Maybe it's millions of individuals buying what the giants were forced to release. Crashes destroy illusions, but they reveal possibilities. The key is not to fear the inevitability, but to see through it. Because the truth is this: we were never meant to survive inside a system built on perpetual debt and artificial growth. That world was always temporary. This collapse is not the end, it is the correction. And corrections, harsh as they are, create clarity. Clarity creates resilience, and resilience creates freedom. The real estate crash is not simply an ending. It is the moment the old order dissolves, and the blueprint for a new one becomes visible. Those who cling to the past will be crushed by it. Those who see what rises afterward will shape it. In the end, inevitability is not doom. It is the beginning of understanding, and the return of control to anyone willing to claim it.